Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We help hedge funds, registered investment advisors, family offices, and individuals get better returns in the equity portion of their portfolios. I'm very excited to be here today for our August subscriber meeting with a member of our board of advisors. We have economist Michael Shedlock. He's an award-winning economist, and he is such a well-known name that, like Madonna, Cher, or Fabio, he is the only economist who goes by a mononym. We refer to him as Mish. Mish, thanks for being here. Glad to have you.
It's a pleasure to be on. By the way, I have no formal training in the economy at all, but one of the finest compliments I ever got was from Lacey Hunt at Hoisington Management. I think everyone recognizes that name. If not, they should. Someone asked Lacey one time, what do you think of this Mish guy? And he goes, well, for someone who's had no formal training in the economy, he's one damn fine economist. So if I can, throw that out. But, Lacey went on to tell me he had to unlearn everything that he learned, in formal education. So maybe not being a trained economist is an advantage here, Gary.
I agree with you. And in fact, just yesterday, one of my favorite Twitter followers, the pseudonymous, I'm mispronouncing that. He operates under a pseudonym, Rudy Havenstein. He just retweeted something about you being an excellent economist precisely because you didn't have to unlearn the Keynesian nonsense they're teaching at universities these days. So this is well recognized on your part.
Well, thanks. I appreciate that.
All right, so let's jump in. Let's start with macroeconomics. The big issue for the last year and a half has, of course, been the Federal Reserve. My view is that the Fed is more likely to hike one or two more times this year than they are to hold firm and not hike at all. And the reason I think that is because the employment market rather, is still strong. Now, people are pointing out all kinds of issues with the numbers. You have a lot of people with multiple jobs. There was an article out today, and I know you follow the birth-death model, pointing out we actually may have shrinking employment rather than growing, depending on how these things are accounted for. But the numbers that the Fed looks at are still very strong. The other thing that I'm thinking is I think we're going to see a huge increase in the cost of food and energy. And that's, somewhere that's more than 20% of the index right there. Housing isn't coming down the way people thought. And so we actually could see an increase in the CPI, and in particular, even the core CPI, even though it excludes food and energy. But all of these things, they're going to be looking at big numbers. And I think all these people talking about a Fed pivot to lower rates, it's not coming this year. And I think we're more likely to see one or two more hikes than even having them hold at the current level. What do you think?
I kind of agree with you, and that's it's a bit of a contrarian take in a lot of ways. People are pricing in this soft landing. I don't think it's going to happen. I think it's possible we're in recession right now, and that no one's recognized it, simply because jobs are strong. But if you go back to something that I wrote a year ago, maybe it was even 2 years ago, I actually predicted that we would have a strong jobs recession. And it has to do with demographics. We've got a lot of baby boomers who are retiring. There's 20 million. The last I looked, I think it's 22 million actually. Boomers of retirement age who are still working, as over the next couple of years, a lot of them, when they hit 65, 66, 67, they are going to be retiring. That does not add to unemployment. It subtracts from employment, right, but it doesn't add to unemployment. So, that's one of the reasons why we see these, low, unemployment rates. And I have not been expecting this huge jump in unemployment that most people have, related to a recession. In other words, Gary, I look at it as the opposite of what we saw in 2020. We had a extremely deep, the deepest recession ever in terms of economic losses and job losses, but it was the shortest recession. It didn't even last a full quarter. Now, the way it's recorded is it happened over 2 quarters, but it was 1 month, 1 quarter, and the first month of the next quarter. So we had essentially a 2-month recession. And I'm thinking this recession is going to be the opposite of that, Gary. So we are going to have a long, drawn out period of slow economic growth where from an employment standpoint and an unemployment standpoint, it's going to be relatively minor compared to 2020 and compared to 2008. So if you just think of it in those terms of demographics and the opposite of the last 2 recessions, you get to the point of view where you and I are in agreement on this.
Yeah, I think so as well. I want to ask you about your view on recession and what you're looking at that has us in recession now. But before we do that, I want to make a comment for the people listening. Mish made a really interesting point about how the unemployment rate is calculated. And there's some quirky numbers in here, and it's worth explaining. So the numerator is how many people are looking for work. The denominator is how many people, the denominator is how many people are looking for work, right? And so, or employed. And so we can have quirky situations. Like a couple of months ago, we actually had a huge increase in employment. The payroll number went up, but the unemployment number went up. And the reason for that, in my opinion, is because wages had gone up and it was bringing people in off the sidelines. You had people who weren't working, who might have been on welfare, said, you know what, at a certain wage level, I'm going to come in off the sidelines and go to work. And so we had a situation where employment and the unemployment rate went up together. This last month, we saw something a little bit different, where the unemployment rate dropped. And normally that would be a good thing. We'd say, hey, wait, we want a low unemployment rate. And that number specifically scared me. It worried me, because to me, what it says is a lot of people were saying, you know what, I don't really want to be part of the workforce. Instead of producing, I'm just going to consume and not join the workforce or drop out of the workforce. And there are a lot of reasons people can do it. Mish is talking about age. There's an age where people will step back. Some of it will be wage related or lifestyle related, but anytime you see employment going up and the unemployment rate going down, going up, it's telling you have, down, it's telling you have people who are returning to the sidelines. And that's the thing that concerned me. Mish, what are your thoughts on that?
Yeah, that's correct. The thing that most people have missed, though, Gary, is the number of hours that people are working. We're seeing these job payroll numbers go up and up and up and up. And, and I've commented on it. Well, my gosh, why isn't the employment level going up? This is a function of a couple of different things here. There's 2 different surveys. The unemployment number comes from the household survey. It's actually a phone survey that a lot of people don't put a lot of faith in. But I think at economic turns, it's more likely to be correct than the jobs number. And the jobs number is kind of skewed because people are working multiple jobs and fewer hours at them. And one of the things that we've seen is for the last, I think 2.5 years, I'd have to pull up my chart and look at it. This is off the top of my head. We've seen the number of hours that people are actually working. And I did this across by job type, by job sector, every sector that I looked at, the number of hours that people are working has been declining. So what is that a function of? That's a function of demographics, people wanting to work, fewer things. It's a function of people just deciding for whatever reason that they don't want, to be working all of these hours. It's a function of some of the memes of the day, Gary, which is, act your wage, and the newest one, what is it called? Working girl. What is that? You know what I'm talking about?
Lazy girl.
I'd never heard of it until a couple of days ago, but it was,
Is it
people are
Lazy Girl
looking for
Job?
jobs
Is
where
that the
they
one?
don't have to work,
Yeah.
and so, add all of these things together. And if you look at just the total number of hours worked, it's actually declining despite these huge rises, allegedly, and people employed. And it's the latter, and this supports my arguments on gross domestic income versus gross domestic product. These numbers widely diverge, one of the largest divergences in history. People look at these gross domestic product numbers, and gross domestic income is supposed to equal. When income has been negative for 2 quarters, GDP is going the other way. But which one of these numbers do you believe? I happen to believe, based just off of looking at hours, off of demographics, off of everything else, off of payroll tax data, that says, the income view of things is more accurate than the product view of things, when they're supposed to equal, and they will over time, Gary. As soon as the BEA and BLS are done with their revisions, these two things are going to equal.
Yeah, I was looking, I forget who it was. There was an economist on Twitter a day or two ago writing about how on any given day, a third of people who are employed aren't working. It's exactly what you're talking about. You may have a lot of people with a lot of jobs who aren't working very much.
It was the lazy girl job. I think people are looking for the lazy girl job. And there's a person on TikTok, that is like has millions of followers telling people, how to look for a lazy girl job. I think it's defined as a job that pays really well, where you don't have to do anything.
Yeah, and for everybody listening to this who's upset, neither Mish nor I are the ones responsible for the term lazy girl job. It was the woman with the TikTok profile. She was the one calling it a lazy girl job. So if you're upset by it, at her and not us. We didn't come up with a name.
Yeah, but act your wage, lazy girl job. And then there's one more meme. If it comes to my mind, I'll throw it out there. But there's 3 of these things out there, all a symptom of current events, really.
Yeah, I'm with you. So you're saying you think we're in recession already?
I think we might be.
Yeah.
I don't know that we are. It strikes me as odd. People are so convinced that we're not, despite, we've never seen industrial production peaked. I think 3 or 4 quarters ago, or a couple, 8 months ago, maybe 2 quarters ago, peaks in industrial production happen, with recession. I did a post, the other day on, I've been commenting about it lately on GDP versus gross domestic income. I just became aware of a few days ago of a Philadelphia Fed calculation of GDP. It's not an average of GDP and GDI. I don't know precisely, and the math behind it is complicated of how they put it together, but I can say that it's overweighted towards the GDI model of looking at things. And I talked about, that how it's called GDP plus. It's from the Philadelphia Fed, how it's a better measure of GDP than either GDP or GDI. And I did a follow-up on this, and I'm not posted it yet. I've got to call into the Philadelphia Fed, or I'm going to make a call because I've got some questions about it. But I downloaded their data last night. I've not posted it yet, but I produced a chart, Gary, and I'm really quite amazed by it, because since 1960, there have been 9 recessions. And every time, without fail, when GDP plus has gone for even one quarter negative by 0.3 or more, the economy has been in recession or would be within 2 quarters. I've not found any other measure that's better at predicting recessions than this one. The Philadelphia Fed did not talk about that aspect. I've got a chart of that, and I'm going to show, when GDP plus went negative by 0.3% or more, and that's not a lot, that the economy was already in recession or would be within 2 quarters. And we've had 2 consecutive quarters here of GDP plus being negative, and both times by more than 0.3%.
Yeah, sorry, I just had to mute someone there. For the people listening to this who aren't familiar with the economic jargon, Mish, give me 1 second. Let me just explain what we're talking about. GDP is gross domestic product and is supposed to be a measure of quantifying the amount of economic activity we have here in the United States.
The value of the products produced.
Exactly. Yes. Thank you. GDI, gross domestic income, would be the sum total of everybody's paychecks during this period. And so the point that Mish has made is that these things should even out over time. Your production should match your income one way or another, because all production, the income will end up in somebody's pocket one way or another. And so what we're seeing recently, and Mish does a great job of tracking this, and I'm going to tell you, you should all check out his website, mishtalk.com, mishtalk.com. But he's tracked, there is a growing divergence. And part of that is because the way our government quantifies these things, the way they calculate this data is skewed and adjusted, and it is designed not to present us with anything resembling a version of the truth, but rather to advance a narrative. And it's something that at Deep Knowledge Investing, we've been writing about for well over a year, that all government statistics are just made up to advance a narrative. There's not even an attempt to try to quantify anything that's useful. And so this new GDP plus, which Mish is talking about, which combines gross domestic product, gross domestic income, and a whole bunch of other calculated math along the way, the thing that I would point out is, yeah, they're just adjusting 2 different sets of inaccurate numbers along the way. You think that's an accurate way to?
Yeah, that's exactly it. In fact, their statement was, well, if you had to choose between the 2 of them, this is from the exact quote from the Philadelphia Fed, or my paraphrasing it.
Yeah.
If you had to choose between the 2 of them, gross domestic income is probably a better measure. He said, but we don't have to choose between the 2 of them. We can take, each of them has errors. We can try and eliminate the errors and try and merge them in a way that makes the most sense, and that's what they've done. And it was the predictive power of that caught my eye, because, on a gross domestic product basis, we see the economy, dip. We see that number go negative quite often, and there's not a recession with it. In fact, we've seen many times where we've had 2 consecutive quarters of one of them recently of negative gross domestic product and no recession. Yet what I was saying when I look at this GDP plus model. We've never seen until now, if we're not in recession, we've never seen this thing go negative for even one quarter without the economy either being in recession or soon to be in recession within 2 quarters.
Got it. All right. So let's move on. I want to talk about this potential BRICS currency issue. As a way of introducing this to everybody, at Deep Knowledge Investing, we have been concerned about the value of the dollar since November of 2021. We warned people that inflation was going to be huge, not transitory, and a major problem. And more than anything, the reason for this is the US government has printed trillions and trillions of dollars of currency. And, this recent budget standoff that we've had about a month ago, maybe a little bit more, the supposed draconian, horrible compromise is that they're going to increase the debt by another $4 trillion over less than 2 years. They're going to overspend by more than $2 trillion. And please keep in mind, that's the on balance sheet number. When you start to add in the additional accruals for non-balance sheet, off balance sheet liabilities, things like Social Security, Medicare, Medicaid, welfare, all of the social safety net things, pensions, our estimate of the amount of governmental overspending every year, including these additional liabilities we're taking on, is somewhere in the neighborhood of $6 to $7 trillion. These numbers are massive. It can't be paid. It won't be paid. And so as a result, right, we've been very concerned about the value of the dollar. Now, between that and the poor design of the anti-Russian sanctions, and please realize, we are not taking the side of the Russians. We're saying the American response was not well designed to actually hurt the Russian economy. It was designed, maybe unintentionally, to hurt the value of the dollar. But what's happening is more than half the world by population is saying we want to be off the dollar standard, or we want to start to move off the dollar standard. And the reason for that is because if you're a foreign country and you're holding dollar reserves, one, the government has made it clear, the US government has made it clear that if they don't like you, your policies, your behavior, they will grab your reserves. They will take your money. And that's not a position a sovereign nation wants to be in. The second issue is, now imagine you're a foreign country and you send the United States goods, energy, these commodities, these very important tangible things that give us a very nice quality of life. And in return, the United States sends you these fiat dollars, and with unlimited printing, additional trillions of dollars of printing a year. And those dollars don't necessarily have a whole lot of value. And as a result of that, more and more countries are saying, we really want other options. Now, the BRICS countries that started as a coalition between Brazil, Russia, India, China, and South Africa, but a couple dozen other very large countries have started to join. And at this point, it's more than half the world's population. Now, they have talked openly about trying to put together their own currency as a competitor to the US dollar. Now, Mish and I have discussed and debated this. He and I are on the phone at least twice a week talking about this, and we have slightly different points of view. And so, Mish, I want to go to you and get your view on it. But I'm just going to put out there, I'm going to acknowledge there are certain issues with having a multinational currency. There are issues with trust related in particular to Russia and China. But I do believe that these BRICS countries are doing something very smart, which is they're talking openly about backing this potential new currency with commodities and in particular gold. Now, an obvious argument is, hey, we don't have enough gold to fund these balance of trade payments, but there are other commodities they could back it with. Regarding the trust issue, I would say that when the US is printing an additional $2 trillion every year and accruing liabilities of maybe $7 trillion additional every year, we're not acting in great faith either. And so you have these countries that they want to come off of the dollar standard. I think too many people are dismissing the potential for a BRICS currency too quickly. And again, I'm not saying I want it to work. We're not talking about the outcome we'd like to have. We're talking about reality, and sometimes reality can be unpleasant. That's my view on it. Mish, I know you agree with me on some things. You got a different point of view on others. Let's hear it.
Okay, let's start off with where I agree with Gary on two key points. First off, on the issue of trust, there's no trust anywhere. At least there shouldn't be any trust anywhere. Not in the dollar, not in the yuan, not in the renminbi, not in the euro, certainly, not in the yen, not anywhere. There should be no trust anywhere. I think Gary and I both agree on that. And the second thing that I think Gary would agree on is this: currencies don't float, they sink at differing rates. Okay, I don't know if Gary's heard that phrase before,
I love
but that that's how I like to look at things. So everybody is doing the same kinds of things no matter where you look. Brazil, Russia, India, China, US, we're all printing. The debt in China is worse than the debt in the United States. So for all the talk about, look at all of our debt here, we'll look at all of the debt in China, and the state-owned enterprises and the command economy system tells me that the mess in China is way worse than the mess here. The third thing we would agree on is that the US unwisely weaponized the US dollar. The Fed went out and as a result of the Russia invasion of Ukraine, neither Gary or I support that invasion, and we're not taking the side of Russia here. We're just looking at what the Fed did and whether or not it was legal, not only by international standards, but by US law. There is no mandate for the Fed to go out and seize the foreign reserves of another country, period. It is not in their mandate at all. The Fed has a mandate to for maximizing employment and also on inflation, having a stable dollar, which they ridiculously define as losing 2% a year forever.
Stable is not 2%. Stable is 0%
Yeah, exactly.
inflation. It's not the same thing.
But nowhere
Right.
does anything allow the Fed to go out and steal the assets of Russia. And that is exactly what we did. Whether you agree with the Russia invasion or not, the US did something that was illegal. And you can't undo this. The US weaponized the dollar. We had a second instance of the US weaponizing the dollar when Silicon Valley Bank went bankrupt. We paid off all of and made the balances good for all US depositors at Silicon Valley Bank. Any foreign depositors in Silicon Valley Bank, I don't know if you knew this, Gary, their assets were wiped out. So that is the second instance of the US weaponizing the dollar. And I think if I can say a fourth point that I would agree with Gary on is that this is certainly going to matter at some point. Where we disagree is the timing on when that is going to matter and what they're going to do about it. But certainly Brazil, Russia, India, and China have gotten together. They said that we're going to come up here, with this currency. Unfortunately, there are no details on this. So we just hear all the speculation about it being backed by gold. Well, it won't be backed by gold. I'm just going to tell you right now, it won't be. If they do, they might do it in a way that makes it appear that it's backed by gold. But it won't be, because unless it freely floats and is exchangeable on demand by gold. My position is it's not backed by gold. And nothing has been backed by gold ever since Nixon took the US off the gold standard, defaulted on it in August of 1971. And by the way, if you look at any number of charts going back to 1971, we see debts, credit card balances, the price of everything just, went nuts everywhere in the United States and everywhere as of that date. And we're still suffering the consequences because nowhere, anywhere in the world is there any restrictions on the amount of debt that a country can have. And as I said, China is no better than the US. And in fact, the yuan doesn't even float. So to suggest that all of these countries that have nothing to do with each other in common, other than a desire to not have the dollar be the world's reserve currency, or at least a claim of that, to get together and formulate this currency that won't be backed by anything, that will be used for trading purposes only, and on the basis of that there's no trust in the United States. Well, where is their trust in China with its property boom that's imploding, with its debt bubble that's even worse, when the yuan doesn't float, when China has capital controls? So to me, this whole thing about the BRIC amounting to anything anytime soon is total nonsense. That, I would say, is Gary and I's biggest disagreement, even though we agree on all of the factors that are surrounding it, like why they want to do this. And if you look at the number of sanctions that the US, and I'm meaning to do a post on this, Gary, because it's really quite fascinating. The US is resorting to sanction policy, as a means of getting what it's want, so much so that even the EU is sick of the United States doing this. But one thing that the EU, the European Monetary Union, the EMU, the Eurozone, in effect, has proven is that currencies with based off of with no fiscal union but a monetary union never work. The euro is already a proven failure at that, and you can prove that just by looking at the difference in interest rates on the bonds of the nations that make up the EMU, the Eurozone Monetary Union, the Eurozone, that this currency is not going to work. And at least the European countries have something similar in common, whereas Brazil, Russia, India, China, and a large number of countries in Africa that don't amount to a hill of beans, they're not large countries, by the way, economically speaking, that are somehow going to make this trading currency work. Well, sorry, color me skeptical. It's not going to happen anytime soon, Gary.
So it sounds like we actually agree on the fundamentals here, but the real issue is the timing. I think by definition, these things all happen. All empires, the currency collapses in the same way. And we see this again and again. I think what we're really talking about here is timing. Let me just throw up a chart to show people what we're looking at here. So I'm sharing my screen now, and what you can see is if we go back just a couple of decades, this is the dollar as being used as a reserve currency at 71%, down in 2021, 59%. And if we do a more recent calculation, in the last 2 years, this share has dropped down another 4% to 55%. And so what we're seeing here, let me get rid of that. What we're seeing here is there is a definite move. by other countries to say they want less exposure to the dollar. So I think what we're talking about here, Mish, is the timing. And you're right, that one is a tough one. A few other things you said that I think are really worth responding to. One, where you were talking about how there's no trust anywhere. And you're right, nobody, no country has acted in a trustworthy manner. And trust shouldn't be required. This is a perfect advertisement for Bitcoin. The great value of Bitcoin is that it is trustless. You do not need to trust the person you're transacting with. You don't have to worry about them confiscating anything. That's right there, a great Bitcoin commercial. Two other points I'll make. For everybody watching this, I threw a link in the chat to an article that I wrote at this point almost a year and a half ago, right after the Russian invasion. And it was an article talking about how the US anti-Russian sanctions were not going to hurt Russia, but rather were going to impact the value of the dollar. And what we've seen is that dollar share is continuing to fall, and more than half the world, successfully or not, they're looking for an out right now. And this is something that I wrote about in April of 2022. That link is in the chat. Final thing is, Mish is talking about weaponizing the dollar. And what he's talking about, and I agree with him entirely, is the US stole the reserves of Russia. Now, let's just talk about this for a second.
And we're threatening to do that to China, by the way. So
exactly. Yeah. And so here's the thing. Are the intentions good? Yeah, of course. Imagine for a minute, you're sitting in the White House and you say, okay, wait, Russia has invaded Ukraine. We don't want them to do that. They're using the money that they have to fund that. We don't want them to do that. We're going to grab their money. We're going to grab their resources. And that will limit their ability to wage war. Seems like a reasonable way to approach it. The problem with the policy, there are two problems. One is it wasn't effective, right? We're a year and a half later, they're not having trouble waging this war. So it didn't work. But more importantly, from the point of view of American interests, what we did was communicated to the rest of the world that your use of the dollar is subject to remaining in the good graces of Washington, D.C., which is a place where ownership, policies, the people in charge, the policies of the people in charge changes every 2 to 6 years. So, today you could think you're an ally of the US, that we're aligned. And, 4 years later, we may have a different president. We may have a different Congress, right? These things change over time. And it's very hard for other countries to remain in the good graces of Washington because Washington is inconsistent. And that is part of our system. But the point is, other countries shouldn't have to worry about their relations with our leaders or their policies to hold the dollar. Because if that's the case, then the dollar is no longer suitable for international trade. And so when Mish talks about, great comment here, we're going to add this. So when Mish talks about weaponizing the dollar, this is what he's talking about. And I agree with it. We just got a great comment from Jim here. Another problem is that confiscating the reserves can be considered an act of war, not much different than taking their land. It's a great perspective, Jim. Thanks for tossing that up there. Mish, I want to talk about the real estate market, but
before we get there, I want we're getting one more comment on here.
Yeah.
What the US did was also inflationary. Right.
Yeah.
We as a result of all the sanction policies that the U.S. has put on Russia and also China, like it or not, or agree with the policies or not, I'm a free market person, so I'm not going to ever agree with sanctions or tariffs, right? But that's just my perspective. But even if let's say you disagree, you need to understand that there's an inflationary aspect of this, because less trade means, actually, historically, it means more likelihood of war, but it also means higher prices. So we said, the supply chain disruptions, and by the way, Russia is still pumping oil. It's just going through extremely circuitous routes, to get to China. So, and instead of Russia natural gas going to Europe, we're exporting liquid natural gas, from the United States across the ocean. And if you're a climate believer, adding to climate woes at the same time. Just so Russia, and they're now producing a pipeline straight between Russia and China so that Russia can get its natural gas to China. So the price goes up everywhere. And what did we solve other than nothing? It's really quite amazing. And we've, added to inflation by disrupting all of these supply chains. And by the way, all of these things that we're doing here, Biden has tariff and sanction policies that are in excess of what Trump did. And recall Trump's statement here, and I don't mean to get into politics here because I don't like any of them, that, Trump said that we would, use these tariffs to pay down the national debt. At the time he said it, the U.S. national debt was $21 trillion. It is now 33.5 trillion or 32.5 trillion, right now. So, the idea that these sanctions are going to do much of anything other than raise prices is just simply wrong.
Yeah, and for clarity here, Mish is not talking about morality. We're not talking about the world as we'd like it to be. He's talking about the pragmatic effect of taking energy supply lines. We didn't stop anybody from using energy, from transporting energy, from buying energy, from receiving funds for energy. We just made the entire system less efficient, leading to greater transportation costs. And again, like Mish said, if you're at all concerned about certain environmental concerns, if you're worried about extra energy use, carbon, things like that, well, guess what? More shipping is more of that. And so he's right. I think Mish is right. We didn't make things better for anyone. We didn't fix any problems. We just made the whole system more expensive, less efficient, and more wasted energy. That's a great point. Let's move on and talk about the real estate market for a minute. We're looking at this really interesting bifurcation in the real estate market. The residential market, even with mortgage rates at 7%, has held up much better than any of us thought it would. A large part of that is people with 3% mortgages are saying, you know what, I'm not going to sell my home. It's very hard to get supply on the market. On the commercial side, there really is an issue. First of all, we're watching hotels go out of business. Malls are in trouble. Commercial office space is really in trouble. This work from home thing has legs in it. And so this is a market that's changing a great deal. I'm going to bring Howard Freedland into the conversation here. He is a member of the Deep Knowledge Investing Board of Advisors. He is a real estate expert, particularly in the South Florida market. And Howard and I were talking yesterday about this. Howard, can you turn your video on, please? We were talking about this yesterday, and his comment.
You need to do it.
Oh, all right. Hang on one second. Here we go. I asked you to start video. Okay. So we were talking about this yesterday. Here we go. And Howard made a great comment to me. He said, with all of these potential bankruptcies and companies handing the keys to office buildings or hotels back, he said, some of the banks may have trouble with this. And we wake up this morning and the market is down huge today because we've got rating agencies downgrading the banks specifically on this issue. I wish we would have done this webinar 24 hours ago, because Howard would, he had this nailed, literally had the timing to within 12 hours. Howard, next time we're going to ask you to see if you can get it down to 6 hours.
I'll work on that. I've been talking about this now for several months, and I wrote in my first half recap of 2023. And by the way, Mish, it's great to see you. I had a great conversation with Mish regarding this just a couple of weeks ago. And that is that out of the $4.4 billion that's outstanding in, you might say, outstanding paper for commercial across the country, 728 billion refinances in 2023, 659 refinances in 2024. You're going to have a lot of massive interest rate changes. And with the number of REITs that are out there that own larger percentages of groups of properties across the country, where razor thin margins are paid attention to, we're going to have to see an increase in supply at some point. Right now, that's what's keeping the pricing where it is just lack of supply.
So one of the things, Mish, I want to get your view on this in a minute, but one of the things that Howard's talking about is this massive wave of refinancing. So you have these companies, they financed their projects or mortgages back in 2018, 2019, and they might have been doing it at 3% or even lower, depending on the corporation. And now we have a situation where they're going to have to refinance at much higher rates. Real estate companies are always highly leveraged. And so when that happens, it's going to blow a gigantic hole through their income statement. The guy who's been talking about that for almost a year is Michael Gayed. He spent the last year posting on Twitter every week, a credit event is coming. Anybody listening to this, you should follow him on Twitter, Lead Lag Report. But he's talked about that. And when he's talked about a credit event coming, he's talking about exactly what Howard is pointing to, which is it's going to be the need of a lot of these companies to refinance at rates that are going to take them from profitable to unprofitable basically overnight. Mish, you've been writing a lot about real estate recently. What are your thoughts?
It's not just office space as people think. We had this huge migration of from everyone was in the office 5 days a week to everyone working from home 5 days a week to it's morphed into something in between. Some companies want their employees back in the office, others don't. The reality is whether employers want employees back in the office or not, we're not going back. But it's not just the office space sector of commercial real estate that's crumbling, it's apartments as well. People went out, bought apartments on leverage. We've already seen some huge defaults. I think it was in California. Was there also some in New York? But this space is going to be huge. It might be even as important or more important than the collapse that we've seen in the office space. So it's just two aspects here of commercial real estate. And if we look back to even the last couple of recessions, even the Great Recession, we didn't see the same kind of thing happen then, primarily because the Fed stepped in and cut rates. Now we're raising rates here. So we've got a different kind of scenario in play here. Commercial real estate is going to be an absolute disaster this time, perhaps even more so than the Great Recession. And that's one thing. Even, home prices have stayed stubbornly high for the reason that Gary, mentioned. No one wants to trade a 3% mortgage for they're over 7% now recently, 7.25% I saw recently. I didn't look at the rates today, so I'm not sure where they are, but they're probably around 7. That's limiting the the resale market. But one thing that the home builders did to circumvent this was they started offering mortgage rate buy downs. The price of lumber crashed, so the home builders could pass on the price of that. They started building smaller houses. They started putting in less features. All the easy stuff's been done. What are they going to do for an encore here now if rates stay high? We're already seeing it. I saw an ad the other day and I clipped it. I've not posted it on my blog yet. I think it was from Lennar, but it doesn't matter. One of the major home builders, talk to us, make us an offer. Wow, we've not seen that kind of thing here for quite some time. In other words, even the home builders now here are starting to take a hit. And guess what? When new home sales go into the gutter, and I think that's about ready to start happening here. They had that tailwind for the reason we just said, but what are they going to do for an encore? And the existing home market has plunged, and I don't think it's going to come back with mortgage rates above 7%. What goes into a house? Appliances, cabinets, durable goods. We've already seen this dual economy here, where the goods side of the economy has plunged. People are buying less things. They're not buying appliances because they're not buying houses. They're not buying lawnmowers. They're not painting the walls. They're not doing new cabinets. All of these things. It's not that they're not doing them. They're just doing way, way less of them than before. How long is this economy going to last, painting each other's toenails and things like that, in the service economy, flying around everywhere with people working fewer and fewer hours? Like we said, I think we're on the last legs here of this service economy, pulling the US economy forever higher.
Yeah, that's a phenomenal point. Howard, I know you got a couple of other comments also. Yeah, Jim just put a great comment and something in the comments here. Howard brings up supply problems, shortages of housing, lending, labor, oil, and gas exist. How does long-term inflation subside in the face of a supply problem, or how do we stimulate more investment? Howard, go ahead.
In brief, I think that the supply problem, I'm going to say this with a caveat, because I said this to Gary yesterday, and I think that we're going to have to see increased supply. The companies that have to refinance, it's over 30% of all of the paper that's out there has to be refinanced. And that's a large quantity. It includes a lot of multifamily. As Mish was saying, it includes more than just your office sector. And you're going to have to see it, or we are going to have another big problem where there is an external force that is saving the companies and investors that are there. There is a lawsuit right now. It's a Chapter 11. Sixtera Technologies out of Miami is claiming that in their bankruptcy proceedings that they need interest rate relief in order to survive. And it's actually in front of legal right now. And I'm not saying that that's going to go through. I mean, I hope not. But at the same rate, I think that the supply issue will get resolved in the next 12 months. And then once that happens, things might balance out a little easier and more nature might take its course. But, I thought that this was going to happen sooner rather than later. And I'm really surprised it's taking as long as it has. Then again, I live in Florida, so forgive me.
Howard, thank you so much. Really
I
appreciate it.
have a question for him. The supply issue resolved how? What do you mean?
So right now, in pretty much every sector except for office, and I'm speaking of my area right now in Florida, every sector seems to have a shrinkage of goods supply. And it's come to the point where good stuff doesn't even make it to the market. There are, deals going on behind the scenes. So what I think is going to be happening is, as these REITs and investors have to shed their investments in order to remain in a positive situation with, their overall income statements, I think that you're going to see more properties on the market. And as there are more properties on the market, again, it begins to affect the pricing.
I'm going to add one more thing to this, because Jim's question doesn't just deal with housing. He's also asking about shortages in oil, gas, energy. So I actually agree with that. And Mish has been writing a ton on alternative energy. The fact is that the current system is actually designed to limit supply of the cheapest, most energy dense materials we have. And we do have shortages. Now, is this good for the country? No, but at Deep Knowledge Investing, our philosophy on this is don't whine, find a way to profit from it. And as a result, we have an enormous amount of exposure to the energy markets. And, subscribers on this call, go to the current recommendations page on the DKI website. And we have lots of recommendations for things like pipeline, oil and gas exposure, uranium exposure, because I can't tell you where the prices of these things are going to be next month, but I know over the next 5 to 10 years, we're going to have shortages because demand for energy is not going down. So I think there are a lot of things going on with this, but there are ways to invest to, at a minimum, protect yourself.
That's another inflationary aspect. And, you can either agree or disagree with what the administration is trying to do with in regards to climate. Europe is in the same boat, except Europe is ahead of the US in one aspect. We're already starting to see some of the political forces like the Green Party in Germany just crumble into oblivion simply because the costs of what they want to do is overwhelming. In the US, we've not hit that point yet. And again, whether you, I don't want to get into the climate debate, but whether you agree we need to be doing some things in that regard or not, the fact of the matter is the policies are very inflationary. When you say we are going to need, and weaponization comes back into play, by the way, right here, because most of the metals that we need for windmills, for military equipment, for batteries for cars, batteries for storage, most of those minerals that we need are not from the United States, they're from China. So the US can weaponize the dollar, China can weaponize minerals. And the bottom line is, so we're trying to go from cheap, abundant resources that we have ample reserves here in the United States to something where we're actually dependent on Russia and China, Congo, Indonesia for some of these metals. And China has already put export tariffs on 2 minerals that we need for military equipment production. You can see this is a very inflationary environment that we are in, whether or not you agree with the underlying policies behind it. So that's one aspect. Another aspect is, okay, what do we do about it? What's happening? And that's what Gary is mentioning here, and why DKI is positioned the way it is in some of its investments. Did I say that accurately, Gary?
Outstanding. That was great. All right, guys, Kamil Homsi sent something fascinating. I'm going to bring him in the conversation in just a minute, but as a way of wrapping up the real estate section of the conversation, we got a great comment from Ramiro on the call, on the chat. And so we'll make the answer to this, the lightning round on the real estate section, and then move on. His question: do you think there will be a once in a lifetime opportunity to buy multifamily properties at a huge discount in a similar way that happened with residential real estate in 2008 to 2010? Or has the work from home situation added unknowns that deem this question difficult to assess? This is a phenomenal question. My answer on this is I don't know, for 2 reasons. The first reason is multifamily property pricing hasn't plummeted yet. I don't know where it's going to bottom out. Or remember, a lot of people living in housing like that are receiving government subsidies. And so, for instance, another member of the Deep Knowledge Investing Board of Advisors, John Jenrette, he invests in housing like that. And, he says everybody always pays. And the reason is the government is paying their rent for them. And so this leads to all kinds of questions related to subsidies and how much money the government's going to print to keep everybody. And the second thing is we are looking in a lot of places at some of the cities where almost everything is multifamily housing starting to empty out. And you have a huge shift from certain cities in New York, Chicago, San Francisco, Los Angeles, where people are moving to other states. They're moving to single family homes. They're moving to the suburbs. And so we'll have to see what happens with that trend. I'm a solid, I don't know on that one, but I think it's a great question. Howard, before we thank you for participating in this, what's your view on it?
Yeah, I don't think we have enough information yet for a once in a lifetime opportunity. But nonetheless, I think that there's going to be more available than currently. And yes, I think the prices will begin to stabilize. They have to. We've been escalating ridiculously for several years now. So I'm going to say this is a wait and see. I can't answer the question yet.
All right. We're going to go to Mish on this one. Howard, thanks so much. I really appreciate you joining us for this.
Thank you for having me.
All right. Mish, go ahead. What's your view?
Way too premature. Here we're in fact, it's in a way the wrong question to be sort of even looking at, because it's like it shows, damn, I'm ready to buy this dip before we've had the dip yet. So I think we need a huge dip. And by the way, I called the bottom of the housing market. I'm not this permanent bear that people think I am, although I just don't see a lot of value out there right now in the US. But but it's like, people are chomping at the bit. And I saw an article just the other day. I can't remember whether it was New York Times or Wall Street, one of the big media outlets. It was like, buy the dip. And I'm sitting there, what? We've not even had a dip. I mean, wake me up after a 30% decline, and then I'll reassess, is this dip big enough or not?
Yeah.
So, this kind of gets back to the husband, kind of question for anyone who follows him. Do we just do a slow grind, or we go steady for 20 years with a stock market doing nothing for valuations to catch up to to reality, or do we have some sort of crash first? And like everyone before me here, I don't know, it's just too premature.
Yeah, I'm with you on that. We're going to bring in Kamil Homsi in just a minute. But before that, we got a quick question from Paul, off topic, but do you think the taxpayers will see anything recovered from the yellow freight bailout? The answer to that is maybe, but it won't be enough money to matter. It is going to be very close to a total wipeout on the $700 million the US handed them. My view on that is, if anyone from the government is listening, enough with the bailouts. Stop it. Stop handing out money. Capitalism needs failure to succeed. This is all ridiculous. And if we as taxpayers recover anything, it is going to be pennies on the dollar. All right,
the most redeeming feature of capitalism is failure. And here we are with and we're in this mess here because the Fed and the government has refused to go along with that, Gary.
Yeah, I'm with you. All right. So joining us now, Kamil Homsi from Global Realty. Kamil is a phenomenal thinker. He is the most international person I know. He's lived in something like 74 different countries. I'm exaggerating, but it's close to that. Speaks, I think, 15 languages. Again, exaggerating, but it's close to that. Kamil, you put a phenomenal question in the chat, but it's long. And rather than have me read your words, just join the conversation and let's hear what's on your mind on the topic of the BRICS currencies.
Good afternoon, everyone. We are a single family office. Our home is Dubai. We are global investors, just like Gary had said. and we focus on alternatives. I definitely visited, I would say, good 90% of the world nations in all continents. And I have closed deals definitely in almost every continent, not almost, in every continent. But my complaint with Gary, that you always introduce me to your great friends, where were you hiding Mish?
You're on with him right now.
Definitely, Mish, you loaded with knowledge and your perspective. And I love the fact you disagree with Gary, because him and I, we always agree and disagree. But our friendship continue to grow, and that's the most important. The way you describe the BRICS, and this is not a critique, this is a conversation that definitely I would ask Gary to schedule lunch, 4 hours lunch, and please, for the 3 of us, so we can settle this. The BRICS countries are loaded with economic issues, each one of them. Okay, they do not share common borders like the Europeans, but just like you predicted for the euro, I agree with you. I wrote a white paper in the year 2000, and I proved to be wrong. I said the European Union will not last 20 years, but now it lasted 23 years, so that means I was wrong. But
well, it's lasted in what way, though? I mean, it's actually totally dysfunctional. But yeah, it's still here.
You're right. But I don't see with their reaction or their wake up from their earlier response to the war in Ukraine, that they did not come in to solve it. They came in with Washington to escalate it. They didn't know that there will be the biggest losers or the first losers. And that's where they are today. That they will be more fragmented day by day because Russia is playing them. And I'm going to say, like you both said, we are not supporting Russia, but Russia is playing a smarter game. They're prolonging this war to become protracted. And that is, I don't see the Russian economy failing like Washington was aiming at. I see the Europeans are becoming more fragmented. But the BRICS countries have concerns about this whole dollar denomination, and also about what they call, they use frequently today in different languages, the word hegemony. That why should the United States, Japan, and the European Union, nations that are laden with debt, laden with economic problems, judge us to sanction us? Why do they have that power? Just because, like one economist one time said, he said, United States has 11 aircraft carriers, so we decide who to sanction. No, United States is not a bully. United States is an economic power and can also manage the world as the big brother, where some will listen, some will half listen, some will not listen. But the way we're going now, we are partitioning the world further. And as an industrial country, and as the country of unicorn, we cannot continue doing this. We have to start dealing with the world with more seeing on the level. I like to share that in the year 1971, Mish, when Richard Nixon, Robert McNamara, Henry Kissinger, Dean Rusk, and all those boys came up with that policy, the population of the United States was 207 million, and the population of the world was, I'm looking at the other screens to give you the exact numbers, was 3,700,000,000. So that put responsibility in the United States to continue printing to maintain circulation of the economies. So that will burden the US and the US citizens at the same time. And that's why Gary said earlier, a lot of those trillions that we are creating of debt cannot be paid. So we as economists, by training or by education, as you said, we have a duty to discuss solutions, because there is a big split between our monetary policy our fiscal policy, and our foreign policy. Those three, they do not walk in the same line. When we bring them together and create a better policy for the big brother that's called the United States, we will do a lot better for ourselves as Americans and also for the world. I'll close by saying I'm not running for an office because I was not born here, because there is only one office that I'll be looking at, and the one that required that I be born here. So I will stop here and thank you.
All right. Thanks, Kamil. Great having you on. We're going to let Mish respond and then wrap it up. Thank you so much.
The one aspect, actually a couple of aspects of trade that are actually important that people don't realize is, we talk of these debts between countries. China and Japan have accumulated, all of this debt, but that's really not the way it works. Trade is between individuals and companies, not between governments. It's only because of the screwy way that we record GDP that we think of exports, we think of imports being a drain, a subtraction from GDP.
Right.
Imports don't really subtract from GDP. They can't by definition. GDP stands for gross domestic product, and imports have nothing to do with it. But the reason why we subtract imports from GDP is because they consist of things that should not have been added in there in the first place. So when you go to the store, you go to Home Depot and buy a drill, that drill was manufactured most likely in China. We add that. That sale is recorded as if that product was manufactured here in the United States. So we add all of these things together, and at the end of all of that, that drill, which was not produced in the United States, never should have been in US GDP. So we subtract that, we look at these, we accumulate all of these balances. We say, okay, China's buying all of these treasuries. We need to subtract that from GDP. That's the reason why we do this subtraction. It's not because imports subtract from GDP. It's we need to do this calculation because we put something into our GDP that never should have been there in the first place. And the second thing is, people talk about, China's selling its reserves, China's selling its treasuries, it's doing this, it's buying, the latest thing I heard was it's selling treasuries to buy natural gas from Qatar. Well, that's not really happening. What's happening is China is masking where it's holding its treasuries. China holds a lot of treasuries in state-owned enterprises that don't appear on the balance sheets of China. So the subtraction of China reducing its holdings of U.S. treasuries is largely inaccurate. And then the third thing is it's because of what Nixon did, the ramifications of that. It's almost an exorbitant privilege. On one hand, China is Brazil, Russia, India, and all these countries are sick of having to deal in dollars and are fearful of U.S. sanctions, and rightfully so. But China has a model that's dependent on export mercantilism, and Germany is the same way in the EU. If you have the world's reserve currency, you don't have much of a choice. The U.S. has to absorb, the savings, from China. The China would not want to have the world's reserve currency, despite all of its talk, because it wants to have its export model. Look at all of the imports coming in the United States from all over the world. if China floated the yuan, if the yuan really became the world's reserve currency, that China would have less control of that demand. So China is complaining about things that we can understand, but they really would not necessarily want to flop positions with the United States. So there's a lot of nonsense that's been said over the years about trade. I would advise people to follow Michael Pettis on Twitter. That's where I learned most of what I know about trade. And so many people have so many things backwards. And I'm happy to, let people or to pass on some of the things that I've learned from Michael Pettis. So thank you, Michael Pettis, for your part in educating me about how trade functions from a global standpoint.
Yeah, it's a great point, Mish, and we're way over time here, so I'm going to get us wrapped up. But there's something that you commented on that came up actually a year ago. I, as somebody trying to make money, help Deep Knowledge Investing subscribers make money, I'm very focused on what's happening here in the US. And part of that is taking a very clear, honest look at some of the flaws we have in our system, because you need to understand what's happening in order to make money. And I did a great webinar with Dr. David Glancy from the Institute of World Politics a year ago, talking about the issues facing the dollar as the world's reserve currency and some of the problems with the design of the anti-Russian sanctions, all this stuff that we're talking about. And Dr. Glancy correctly pointed out to me, he said, China has problems too. They have too much debt too. Their economy is not as good as they make it seem. Their numbers are definitely lies. And Mish is making a very similar point right now. And I think it's a great one. And as somebody who's trying to help my subscribers, our subscribers make money, I'm very focused on issues with US policy and US finances. But nobody should think that means that the rest of the world doesn't have their issues, or even similar or worse issues in a lot of ways. And I think that's a great point. Let's get ourselves wrapped up on this. I want to thank Howard Freedland from Ecofine Properties for his great comments on the real estate market, and for his correct prediction on the banks. That was incredible within 12 hours. I want to thank Kamil Homsi from Global Realty Capital for really a firsthand point of view on what's happening in so many of these other countries. And of course, we want to thank Michael Shedlock, Mish, for being a member of the Deep Knowledge Investing Board of Advisors and for sharing your knowledge and expertise with us today. Thank you.
I would be happy, except.
Sorry,
I just had to mute someone there. Mish, thank you so much. Really glad you were able to
my pleasure, Gary. We have to let's get together and do some shorter ones of these where people can, because I didn't mean to drag it out as long as we did. So thanks for having me on.
Perfect. Well, everyone who's listening to this, you can look forward to more Twitter spaces probably between Mish and me. Be on those, participate, ask your questions. So glad to have all of you. And one final thing, thank you to all of our Deep Knowledge Investing subscribers who took the time to be part of this call and submitted really phenomenal comments and questions. Love everything that we got in the comments section. Thanks all of you. Thanks Howard, Kamil, and Mish, and glad to have all of you. I'm Gary Brode from Deep Knowledge Investing, and we're all set here. Thank you.